Financial markets. Sid Best notes. Financial markets. Concept. A financial market helps to link the savers and the investors by mobilizing funds between them. In doing so, it performs what is known as an allocative function. When the allocative function is performed well, two consequences follow. The rate of return offered to households would be higher. Scarce resources are allocated to those firms which have the highest productivity for the economy. There are two major alternative mechanisms through which allocation of funds can be done: via banks or via financial markets. The process by which allocation of funds is done is called financial intermediation. Banks and financial markets are competing intermediaries in the financial system, and give households a choice of where they want to place their savings. A financial market is a market for the creation and exchange of financial assets. Financial markets exist wherever a financial transaction occurs. Financial transactions could be in the form of creation of financial assets such as the initial issue of shares and debentures by a firm, or the purchase and sale of existing financial assets like equity shares, debentures and bonds. Functions of financial market. 1. Mobilization of savings and channeling them into the most productive uses. A financial market facilitates the transfer. 2. Facilitating price discovery. 3. Providing liquidity to financial assets. 4. Reducing the cost of transactions. Money market. The money market is a market for short-term funds which deals in monetary assets whose period of maturity is up to 1 year. Money market instruments. 1. Treasury bill. Short-term borrowing by the Government of India. Maturing in less than 1 year. Zero coupon bonds issued by the Reserve Bank of India. Form of a promissory note. Highly liquid. Assured yield. Negligible risk of default. Issued at a price which is lower than their face value and repaid at par. The difference between the price at which the treasury bills are issued and their redemption value is the interest receivable on them and is called discount. Available for a minimum amount of Rs 25,000 and in multiples thereof. 2. Commercial paper. Short-term unsecured promissory note. Negotiable and transferable by endorsement and delivery with a fixed maturity period. Issued by large and credit-worthy companies to raise short-term funds at lower rates of interest than market rates. Maturity period of 15 days to 1 year. It is sold at a discount and redeemed at par. For seasonal and working capital needs. Bridge financing. 3. Call money. Short-term finance repayable on demand. Maturity period of 1 day to 15 days. Interbank transactions. Maintain the cash reserve ratio. The interest rate paid on call money loans is known as the call rate. Highly volatile rate that varies from day to day and sometimes even from hour to hour. Inverse relationship between call rates and other short-term money market instruments such as certificates of deposit and commercial paper. 4. Certificate of deposit. Unsecured. Negotiable. Short-term instruments. Bearer form. Issued by commercial banks and development financial institutions. Companies during periods of tight liquidity when the deposit growth of banks is slow. Mobilize a large amount of money for short periods. 5. Commercial bill. Bill of exchange used to finance the working capital requirements of business firms. Short-term. Negotiable. Self-liquidating instrument. Used to finance the credit sales of firms. On being accepted, the bill becomes a marketable instrument and is called a trade bill. These bills can be discounted with the bank if the seller needs funds before the bill matures. When a trade bill is accepted by a commercial bank, it is known as a commercial bill. Capital market. Capital market refers to facilities and institutional arrangements through which long-term funds, both debt and equity, are raised and invested. It consists of a series of channels through which savings of the community are made available for industrial and commercial enterprises and for the public in general. It directs these savings into their most productive use, leading to growth and development of the economy. The capital market consists of development banks, commercial banks and stock exchanges. An ideal capital market is one where finance is available at reasonable cost. It is essential that financial institutions are sufficiently developed and that market operations are free, fair, competitive and transparent. The capital market should also be efficient in respect of the information that it delivers, minimize transaction costs and allocate capital most productively. Development of the financial system is seen as a necessary condition for economic growth. The capital market can be divided into two parts: A. Primary market, B. Secondary market. Distinction between capital market and money market. I. Participants. 2. Instruments. 3. Investment outlay. 4. Duration. V. Liquidity. V. Safety. 7. Expected return. Primary market. Methods of flotation. 1. Offer through prospectus. 2. Offer for sale. 3. Private placement. 4. Rights issue. 5. EIPOs. Secondary market. Primary and secondary markets. A comparison: primary market, secondary market. New issue market. Stock exchange. I. There is sale of securities by new companies or further new issues of securities by existing companies to investors. 2. Securities are sold by the company to the investor directly or through an intermediary. 3. The flow of funds is from savers to investors. that is, the primary market directly promotes capital formation. IV. Only buying of securities takes place in the primary market. Securities cannot be sold there. V. Prices are determined and decided by the management of the company. V. There is no fixed geographical location. I. There is trading of existing shares only. 2. Ownership of existing securities is exchanged between investors. The company is not involved at all. 3. Enhances encashability liquidity of shares. That is, the secondary market indirectly promotes capital formation. I. Both the buying and the selling of securities can take place on the stock exchange. V. Prices are determined by demand and supply for the security. V. Located at specified places. Stock exchange. Meaning of stock exchange. Functions of a stock exchange. 1. Providing liquidity and marketability to existing securities. 2. Pricing of securities. 3. Safety of transaction. 4. Contributes to economic growth. 5. Spreading of equity called. 6. Providing scope for speculation. Trading and settlement procedure. Steps in the trading and settlement procedure. The following steps are involved in the screen-based trading for buying and selling of securities. 1. If an investor wishes to buy or sell any security, he has to first approach a registered broker or sub-broker and enter into an agreement with him. The investor has to sign a broker-client agreement and a client registration form before placing an order to buy or sell securities. He has also to provide certain other details and information. These include PAN number. This is mandatory. Date of birth and address. Educational qualification and occupation. Residential status. Indian NRI. Bank account details. Depository account details. Name of any other broker with whom registered. Client code number in the client registration form. The broker then opens a trading account in the name of the investor too. The investor has to open a demat account or beneficial owner (BO) account with a depository participant (DP) for holding and transferring securities in the demat form. He will also have to open a bank account for cash transactions in the securities market 3. The investor then places an order with the broker to buy or sell shares. Clear instructions have to be given about the number of shares and the price at which the shares should be bought or sold. The broker will then go ahead with the deal at the above-mentioned price or the best price available. An order confirmation slip is issued to the investor by the broker for. The broker then will go online and connect to the main stock exchange and match the share and best price available. 5. When the shares can be bought or sold at the price mentioned, it will be communicated to the broker's terminal and the order will be executed electronically. The broker will issue a trade confirmation slip to the investor. 6. After the trade has been executed, within 24 hours the broker issues a contract note. This note contains details of the number of shares bought or sold, the price, the date and time of deal, and the brokerage charges. This is an important document as it is legally enforceable and helps to settle disputes claims between the investor and the broker. A unique order code number is assigned to each transaction by the stock exchange and is printed on the contract note 7. Now, the investor has to deliver the shares sold or pay cash for the shares bought. This should be done immediately after receiving the contract note or before the day when the broker shall make payment or delivery of shares to the exchange. This is called the pay-in date. Cash is paid or securities are delivered on pay-in day, which is before the T+2 day, as the deal has to be settled and finalized on the T+2 day. The settlement cycle is on T+2 day on a rolling settlement basis. WEF April 1, 2003. 9. On the T+2 day, the exchange will deliver the share or make payment to the other broker. This is called the payout day. The broker then has to make payment to the investor within 24 hours of the payout day, since he has already received payment from the exchange. 10. The broker can make delivery of shares in debit form directly to the investor's debit account. The investor has to give details of his debit account and instruct his depository participant to take delivery of securities directly in his beneficial owner account. Dematerialization. This is a process where securities held by the investor in the physical form are cancelled and the investor is given an electronic entry or number so that he can hold it as an electronic balance in an account. This process of holding securities in an electronic form is called dematerialization. For this, the investor has to open a debit account with an organization called a depository. In fact, now all initial public offers, physical shares can be converted into electronic form, or electronic holdings can be reconverted into physical certificates. Rematerialization. Depository. Depository. Just like a bank keeps money in safe custody for customers, a depository also is like a bank and keeps securities in electronic form on behalf of the investor. In the depository, a securities account can be opened. All shares can be deposited. They can be withdrawn, sold at any time, and instruction to deliver or receive shares on behalf of the investor can be given. It is a technology-driven electronic storage system. It has no paperwork relating to share certificates, transfer, forms, etc. All transactions of the investors are settled with greater speed, efficiency, and uses all securities are entered in a book entry mode. In India, there are two depositories: National Securities Depositories Limited, NSDL, is the first and largest depository presently operational in India. It was promoted as a joint venture of the IB, UTI, and the National Stock Exchange. The Central Depository Services Limited, CDSL, is the second depository to commence operations and was promoted by the Bombay Stock Exchange and the Bank of India. Both these national-level depositories operate through intermediaries who are electronically connected to the depository and serve as contact points with the investors and are called depository participants. The depository participant (DP) serves as an intermediary between the investor and the depository NSDL or CDSL, who is authorized to maintain the accounts of dematerialized shares. Financial institutions, banks, clearing corporations, stockbrokers and non-banking finance corporations are permitted to become depository participants. If the investor is buying and selling the securities through the broker or the bank or a non-banking finance corporation, it acts as a DP for the investor and complete the formalities. Securities and Exchange Board of India, SEBI. The Securities and Exchange Board of India was established by the Government of India on April 12, 1988 as an interim administrative body to promote orderly and healthy growth of securities market and for investor protection. It was to function under the overall administrative control of the Ministry of Finance of the Government of India. The SEBI was given a statutory status on January 30, 1992 through an ordinance. The ordinance was later replaced by an Act of Parliament known as the Securities and Exchange Board of India Act, 1992. Objectives of SEBI: 1. To regulate stock exchanges and the securities industry to promote their orderly functioning. 2. To protect the rights and interests of investors, particularly individual investors, and to guide and educate them. 3. To prevent trading malpractices and achieve a balance between self-regulation by the securities industry and its statutory regulation. 4. To regulate and develop a code of conduct and fair practices by intermediaries like brokers, merchant bankers, etc., with a view to making them competitive and professional. Functions of SEBI. Regulatory functions. 1. Registration of brokers and sub-brokers and other players in the market. 2. Registration of collective investment schemes and mutual funds. 3. Regulation of stockbrokers' portfolio exchanges, underwriters and merchant bankers, and the business in stock exchanges and any other securities market. 4. Regulation of takeover bids by companies. 5. Calling for information by undertaking inspection, conducting enquiries and audits of stock exchanges and intermediaries. 6. Levying fee or other charges for carrying out the purposes of the Act. 7. Performing and exercising such power under securities contracts, Regulation, Act 1956, as may be delegated by the Government of India. Development functions. 1. Training of intermediaries of the securities market. 2. Conducting research and publishing information useful to all market participants. 3. Undertaking measures to develop the capital markets by adapting a flexible approach. Protective functions. 1. Prohibition of fraudulent and unfair trade practices like making misleading statements, manipulations, price rigging, etc. 2. Controlling insider trading and imposing penalties for such practices. 3. Undertaking steps for investor protection. 4. Promotion of fair practices and code of conduct in securities market.